All right, so we're diving into the world of the Federal Reserve.
The Fed.
Yeah, the Fed, using those Wikipedia excerpts you sent over.
Right.
You're clearly interested in this whole uh, powerful institution.
Yeah.
So we're going way beyond the basics today.
Yeah, it's fascinating because like most people just think of it as this mysterious entity,
Right.
but their actions really do have this ripple effect on everyone.
It's true. It's like they're uh, pulling these invisible strings behind the scenes
Mhm.
of the entire economy.
Yeah.
So the documents that you sent over mentions that the U.S. didn't always have the Fed.
Right.
Can you kind of paint a picture of like what led to its creation in the first place?
Yeah, so imagine like a financial Wild West.
Okay.
There was no central bank, no uniform currency or anything like that.
Wow.
It was chaotic. Constant boom and bust cycles. Banks were failing left and right.
Oh my God.
And people would just lose all their savings instantly.
Yeah.
Not a very stable environment to build an economy.
No, not at all.
Well,
Let's talk about a roller coaster ride.
Right.
And then, on top of all that, there was that whole Panic of 1907 situation.
Yeah.
That must have been a turning point, right?
Oh, absolutely. The Panic of 1907 was a huge financial earthquake.
Really?
I mean, just think about it for a second.
Yeah.
J.P. Morgan, a private citizen, had to step in and personally act as the nation's lender of last resort.
Wow.
I mean, that's incredible. It was a major wake-up call
Yeah.
that the U.S. desperately needed a more stable system.
I can only imagine, cue the dramatic music, enter the Federal Reserve Act of 1913.
Yeah.
What a game changer, right?
Huge game changer. I mean, this act gave birth to the Fed.
Right.
It created a central bank with a mission to stabilize the financial system,
Right.
to create a more elastic currency, and to act as that lender of last resort.
Right.
To prevent, another one of those J.P. Morgan situations.
Right, to prevent those from happening again.
Exactly. But what I think is really fascinating is how they actually structured it.
Oh,
They created this really unique kind of hybrid system, this blend of public and private control.
public and private control.
Yeah.
Interesting. Okay, so let's unpack this a little bit.
Okay.
What does quasi-governmental even mean in this context?
Yeah, it's kind of a strange. It feels like they're walking a tightrope between like government oversight and private interests.
Yeah, it does.
And that's exactly what it was. It was a compromise.
Okay.
So you have these 12 regional Federal Reserve banks,
Oh.
each one representing its own local economy.
Okay.
And then above them, you have the Board of Governors.
Yep.
And they're appointed by the president.
Okay.
And they oversee the entire system.
So they're kind of like the overarching.
The bosses.
Yeah, yeah.
This whole blend was meant to prevent any one group from having too much power.
Okay, that makes sense.
But it also raises all these questions about accountability and transparency.
Right, because who are they really answering to?
Exactly.
It's both and neither.
Right.
It's really interesting. So it's like this balancing act.
Yeah.
You're trying to harness the strengths of both the public and the private sectors,
Mm-hmm.
but then at the same time, you're trying to mitigate all the risks.
Right.
And it just makes you wonder how this balancing act actually plays out in practice.
Well, that's the million-dollar question, isn't it?
Right.
And to really understand its impact, we need to look at the powers of the Fed,
Okay.
and in particular, how they influence the economy through what's called monetary policy.
Okay, let's dive into that.
Okay.
Monetary policy.
Yeah.
Okay, so like that sounds kind of official.
Right?
What does that even mean in plain English?
Yeah.
And how does the Fed actually use it to, influence the economy?
Yeah.
It's like we're talking about these like levers and buttons
Mm-hmm.
that
Mhm.
control like the flow of money or something.
Yeah, you're not that far off. I
Right.
mean, monetary policy is essentially how the Fed manages the money supply
Okay.
and credit conditions to try to achieve like its economic goals.
Okay.
So you can think of it as their toolbox for kind of keeping the economy humming along smoothly.
Okay, so what tools are we talking about here?
Right.
Because the excerpts that you sent over mention things like reserve requirements,
Right.
the discount rate,
Mm-hmm.
and open market operations.
Yeah.
And I'm not going to lie, those sound a little intimidating.
Yeah, they sound a lot more complicated than they actually are.
Okay.
So imagine for a second that like the Fed is like a conductor
Okay.
and the economy is the orchestra.
Right.
So one of their tools is reserve requirements.
Okay.
And that's basically like telling each section of the orchestra how many musicians they need to have present.
I like that analogy.
Yeah.
Okay.
It dictates how much money banks need to keep in reserve at any given time.
Okay.
And then there's the discount rate,
Right.
which is basically the interest rate that the Fed charges banks for like short-term loans. So it's kind of like setting the cost for sheet music, if you will.
Okay, so it's getting more and more expensive the more we make it.
Exactly.
Okay, got it.
So those are two.
Yeah.
And then the big one,
Okay.
which you alluded to, is open market operations.
Open market operations. Yeah, that one seems to be like their favorite.
Right. It's the one they use the most often.
The most used tool.
Okay, for sure. It's the most important one, I would say.
Okay, what makes it so special?
Well, it's their way of like subtly adjusting the volume of the whole orchestra.
Ooh, okay, I like that.
Right. So they can buy or sell government securities,
Okay.
like treasury bonds
Right.
in the open market.
Mhm.
And when the Fed buys these securities, they're essentially injecting money into the economy.
They're putting it in.
They're putting it in. Exactly.
Exactly.
Increasing the money supply. When they sell them, they're pulling money out, decreasing the money supply.
So it's not about them literally printing more money.
Right.
It's like they're manipulating how much is actually circulating out there.
Exactly.
Okay, I got it. But then my question is, how does all of this,
Yeah.
like all this wonky behind the scenes stuff, how does it impact me?
Yeah, good question.
The average Joe, just like trying to, live my life.
Sure.
How does this affect me?
Well, it all boils down to interest rates,
Okay.
right? Because remember, we talked about loans and mortgages and savings accounts and things like that.
Right.
So by controlling the money supply, they're indirectly influencing those interest rates that you pay or earn on those very things.
So it is all connected.
It's all connected.
Okay, wow. So let me see if I have this straight. So if the Fed wants to encourage borrowing and spending,
Right.
let's say to boost a sluggish economy,
Mhm.
they might buy securities,
Right.
increase the money supply,
Yeah,
and that would probably lower interest rates.
exactly.
Yeah.
You got it.
Right.
Because lower interest rates make it cheaper to borrow money.
Right.
So that encourages businesses to invest,
Right.
the consumers to spend,
Right.
and then hopefully that boosts economic activity.
It's all tied together. And
Yeah.
then conversely, if they want to tap the brakes on inflation,
Yes,
they could do the opposite.
they could do the opposite exactly.
Sell securities, reduce the money supply, push interest rates up.
Yep.
To encourage saving instead of spending.
It's a delicate dance,
It is a dance.
Yeah.
It really is a dance.
a constant balancing act to kind of keep the economy stable. But, like any balancing act, there can be missteps.
Oh, yeah.
And I mean, think about the Great Depression.
But
I
why
mean,
not?
that's like a very stark example
Yeah.
of how the Fed's actions, or you could even say their inactions,
Right.
can have these really profound and lasting impacts.
Yeah, that period in history always feels kind of shrouded in this, like, what went wrong?
Sure.
Like, what was the Fed's role in all of that?
So leading up to the Great Depression, the Fed was still relatively new,
Okay.
still trying to figure out its place.
They were figuring it out as they went.
Yeah, and a lot of people criticized them,
Really?
saying that they actually made the situation worse
Wow.
because they tightened the money supply in the late 1920s.
Okay, why would they do that?
Well, they were worried about all the speculation that was happening in the stock market.
Okay, so they were trying to, like,
They wanted to cool things down.
yeah.
So they raised interest rates to try to curb that risky behavior.
And it backfired.
Well, the stock market crashed in 1929.
Right.
And instead of loosening their grip on the money supply to kind of provide some relief,
Yeah.
they hesitated.
Really?
Yeah, and some economists say that inaction
Okay.
combined with their earlier tightening,
Yeah.
that basically turned what could have been a stock market crash into a full-blown economic depression.
Wow, so they overcorrected, essentially.
Essentially.
Wow.
Yeah,
It really makes you think about those unintended consequences we talked about earlier.
it does.
Did this whole experience change their approach?
Oh, absolutely. I mean, the Great Depression was a very brutal lesson
I did.
for the Fed, but it really fundamentally changed how they viewed their own role.
Okay, how so?
Well, it really highlighted the importance of providing liquidity,
Okay, and liquidity is like making sure...
making sure there's enough money available in the system, especially during times of crisis.
Gotcha. So instead of slamming on the brakes during a downturn, they learned to be a little more flexible.
Yeah, more supportive. Yeah.
Exactly.
Provide support. Okay.
And if you fast forward to the 2008 financial crisis,
Okay.
you'll see a very different Fed response.
That was another wild one.
Oh, tell me about it.
So how was their approach different during that time?
Well, they were much quicker to act,
Okay.
and they slashed interest rates to near zero.
Really?
which is essentially like giving money away
Wow.
to encourage lending and borrowing.
Okay.
But they went even further than that.
Right. They launched this massive program called quantitative easing.
Quantitative easing.
Ah.
Okay, that sounds intense.
It was big. It was basically open market operations on steroids.
Oh, boy.
They pumped trillions of dollars into the economy.
Trillions with a T.
Trillions with a T.
Wow.
By buying not just treasury bonds, but also mortgage-backed securities,
Okay.
which had never been done before.
So they were really pulling out all the stops.
They were trying to prevent a complete economic meltdown.
Right.
Yeah.
And what about more recently during the COVID-19 pandemic?
Oh, right.
Because that was another economic earthquake.
Oh, yeah, that was another big one.
So how did they react?
Well, the pandemic was yet another moment where the Fed's role as kind of a crisis responder was really thrust into the spotlight.
Totally. Yeah.
So once again, they slashed interest rates to near zero.
Wow. Again.
Yeah, and they pumped trillions of dollars into the economy.
Wow.
But this time, through a combination of lending programs and asset purchases.
So they were getting creative.
A little more creative.
Yeah.
But they also did something really interesting this time. They provided a lot of support to financial markets.
Really?
Specifically to prevent them from completely freezing up.
Wow. So it's like they learned from 2008 and they were like,
Right.
we're not going to let that happen again.
Exactly. It was a much more proactive approach, for sure.
So it seems like they've learned from their past.
Yeah.
They've become a lot more proactive in a way.
I would agree with that.
And they're using their powers more aggressively to try to mitigate these crises.
Absolutely. And I think their actions during these crises really highlight how much their role has evolved.
Okay.
And the sheer scale on which they can influence the economy.
Yeah. It's kind of mind-blowing, actually, when you think about it.
It is.
But, you know, it also kind of underscores all the debates surrounding their power and their independence.
Oh, for sure.
Because the excerpts that you sent over mention that the Fed is specifically designed to be independent of political pressure.
It is.
And that seems really crucial for being able to make those tough decisions, right? But it also raises questions about their accountability.
Of course.
Right? Because how can an institution with this much power operate without any kind of direct oversight from elected officials?
That's the million-dollar question, isn't it?
It really is.
It really is. It's a double-edged sword, for sure.
Yeah.
With valid arguments on both sides.
Totally. So, like, on the one hand, if the Fed were totally beholden to politicians, they might be pressured to make decisions that are politically popular, but maybe not economically sound. Like keeping interest rates artificially low before like an election or something like that.
Exactly.
Right? So I get that. But then on the other hand, shouldn't an institution that has this much power over our financial lives be accountable to the people, or at least our elected representatives?
Right, and that's the heart of the debate.
It is.
Right there.
Wow.
So some people say that the current level of independence is absolutely necessary to make sure that the Fed can make those tough long-term decisions without, you know, bowing to those short-term political pressures. But then others say that this independence creates a really dangerous lack of accountability.
Wow. So there's really no easy answer.
There's no easy answer.
It's a pickle. It's a real pickle. It is. Wow. Well, we've covered a lot of ground here.
We have.
From the chaotic days before the Fed to its evolution into this powerful force shaping the entire economic landscape.
We've gone on quite a journey.
We have, but there's one thing we haven't touched on.
Yeah.
Those potential long-term consequences you mentioned earlier.
Oh, right.
Like, what are those?
Yeah.
We need to dive into that.
We do, because understanding the Fed's past and present actions is obviously crucial.
Right.
But grasping the potential long-term ramifications of their decisions is equally important.
Okay.
And that's where things get really interesting.
Let's do it. Long-term consequences.
Yeah.
Okay, so like, we're stepping into uncharted territory here.
Yeah, a bit.
What are some of the like potential risks or unintended consequences that we should be thinking about?
Well, one big one is inflation.
Inflation. Okay.
We've talked about how the Fed injecting trillions of dollars into the economy during these crises can really help to avert disaster in the short term.
Right.
But what happens when you have all this increased money supply,
Yeah.
but a limited supply of goods and services.
Oh, right. Basic supply and demand.
Exactly.
Too many dollars chasing too few goods.
Right.
Prices go up.
Prices go up, and you end up with inflation.
Which is what we've been seeing.
Exactly. And remember, the Fed's mandate is to keep inflation in check.
Okay.
While at the same time promoting economic growth.
Right. It's tough. It's a tough line to walk.
It's a real balancing act.
It is. So like after 2008.
Yeah.
And even more recently during the pandemic.
Right.
Those massive injections of money.
Huge.
Which, seemed necessary at the time.
Right.
But it seems like they might have contributed to the inflation that we're dealing with now.
They certainly played a role.
Yeah, so it's this delicate balancing act of like trying to provide enough stimulus to support the economy without going overboard and then accidentally creating a surge in inflation years down the line.
You got it.
Okay. Are there any other potential downsides we should be thinking about?
Yeah, definitely. I mean, the Fed's control over interest rates doesn't just influence inflation.
Okay.
Think about it this way. Artificially low interest rates for really long periods can sometimes fuel asset bubbles.
Asset bubbles.
Okay. Think back to the housing market crash before the 2008 crisis.
Oh, yeah.
Right? Super low interest rates made it really easy to get a mortgage.
Right. Everybody was.
Everybody and their brother was getting a mortgage.
Right.
So that led to this huge surge in demand.
Right.
Soaring house prices.
And we all know how that story ended.
Not well.
Not well at all.
Not well. So, yeah, low interest rates.
Right.
Might seem great at first.
Right.
It's easier to buy a house.
Yeah. Get a car.
Whatever.
Right.
But it can lead to this unsustainable boom.
Right.
And then a painful bust.
Yeah, it makes you wonder if there's a way for them to achieve their goals without kind of creating this boom and bust cycle.
Right. But that's the million-dollar question, isn't it?
Yeah, it is. It really is.
That's what economists and policymakers are constantly debating, trying to find that sweet spot.
Right.
Another area of concern is this concept of moral hazard.
Moral hazard.
Have you heard of that?
Yeah, it's like the idea that if somebody knows they're going to be rescued from their mistakes.
Exactly.
They're more likely to just take bigger risks.
Exactly.
Yeah.
Because they know there's no downside.
Yeah, like the banks knowing that the Fed will be there to bail them out.
Exactly. So if banks start to believe that they're too big to fail, they're going to be bailed out no matter what.
Right.
It can lead to reckless lending.
Yeah.
Reckless risk-taking.
Right. It's human nature.
It is human nature.
Yeah.
And that brings us right back to that debate.
There it is.
About the Fed's power and independence.
Right.
How do we balance the need for decisive action in a crisis with the potential for these longer-term distortions?
Wow. That's complicated.
It is complicated.
There's no easy answers.
Not at all.
It feels like the Fed's actions are like ripples in a pond.
Oh, that's good.
Where the immediate impact is visible.
Right.
But those ripples can spread so far and wide.
Yeah.
And we don't know what kind of unintended consequences are going to happen down the line.
Right. They're kind of unpredictable in a way.
Yeah. It's kind of scary when you think about it.
It is. I mean, understanding the Federal Reserve.
Yeah.
It's not about memorizing a bunch of economic jargon.
Right.
It's about recognizing the profound impact their decisions have on our lives, on all of our lives.
It's true.
Both now and in the future.
Yeah, no, this deep dive has been eye-opening. I have a whole new perspective on the Fed.
Good.
That's for sure. I'm definitely going to be paying much closer attention.
I think we all should.
To what they're doing and what they're saying.
Yeah, it affects all of us.
From now on. Well, thanks for being such a fantastic guide.
My pleasure. I mean, knowledge is power, right?
It is.
Especially when it comes to understanding the forces that shape our entire financial world.
I couldn't agree more.
Yeah.
Well said.